Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for this morning, and as always, send your questions to Brian Rezny at ReznyWealth.com, and make sure you visit our website, ReznyWealth.com, for groundbreaking reports. Of course, they're all free. The main thing we like to do with our TV show is educate you, the pre-retiree and retiree, so you can make better financial choices, hopefully avoid the pitfalls that often plague many retirees, eliminate and reduce investment and retirement stress. Doesn't that sound good? And at the end of the day, not only will our TV show help reduce that stress, but those reports and that education on our website is vitally important. I want to talk a lot today about the global investment market and really what's going on with the current political events that you're seeing unfold. Things like tariffs, things like trade deficits. If we're talking about recessions again in various countries, there's been some little talk about recessions maybe in the U.S. Is this fact or fiction? Bottom line, current political events and the global tensions are really changing the investment market opportunities for better opportunities, in our opinion, in the U.S. economy. As I've talked for many years, avoid international investments, avoid emerging markets, avoid Europe and countries outside the U.S. And why is that? Simple. The U.S. is going to be one of the fastest growing, more stable economies in the world. The businesses within the U.S. and our stock market and real estate and bonds, in our opinion, are going to be the best opportunities. Unfortunately, the vast majority of the people listening to our TV show today, you're probably working with an advisor who's fee-based, commission-based, or a combination of the two, and they probably actually don't manage any money, and you probably have the stock asset allocation, and you have a big helping of international in your portfolio that has lagged and brought down your returns and actually created more risk for your retirement. So I would suggest when you get a chance, pull out your statements. Look how much international exposure you really have. You'll be shocked. And then if you look at the returns of that portion, they've been horrific, not only for a year, but 5, 10, 20 years, and don't expect it to get better. Economic concerns. What are our primary economic concerns and challenges that are going to face you today? Simple. People are talking a lot about tariffs. Yes, we are going to put tariffs in place against other countries like Canada, Mexico, China. Does that really hurt the U.S. economy or does it help it? It actually helps it more than it's going to hurt it. The big talk with tariffs is it's going to raise inflation. If you look at the total of all the overall tariffs that are currently being discussed by the current administration, if they raise them in this 25% region, it might slightly raise inflation rates by 0.07%. That's relatively small. So at the end of the day, while it may raise some prices, it's actually going to help increase the U.S. economy, GDP, wages, which is obviously highly beneficial for every American. That's going to be a net positive. So if we take a look at tariffs, we look at geopolitical events around the world, the U.S. is still the most stable place to be. Let's talk a little bit about market projections and what we kind of see for 2025, but not only for 25. You should be more concerned about the next 4 to 5 years. And why is that? Unfortunately, many investors look short-term, short-sighted. Oh my gosh, my portfolio wasn't up in the last 3 months or 6 months. Folks, I'm going to tell you the truth. There's times where maybe things just kind of tread water for 6 or 12 months, and then you have that next explosion up in your portfolio value. Every single year, the markets don't go up 10 or 12%. Sometimes they're up 20, sometimes they're down 3. Again, but it's over that 3 to 5 year average that you're looking for. So if I look at this year for 25, we expect the first 6 months to be more volatile. We've talked about this 10, 12, 15% pullback this year. That's going to be a buying opportunity. I will tell you, we're in the throes of some of that pullback now, and we've been aggressively buying and adding to quality positions within our managed accounts. So there's great opportunity. If I look at the end of 2025, I see more smoother sailing, but I'm looking at the next 3 to 5 years. And if I look at the next 3 to 5 years, if you're properly invested, and if things go the way that we anticipate with a pro-growth economy in the U.S., probably approaching GDP, could be somewhere in the 3 to 4% range as we approach 26, 27, that's going to be a boom for the overall U.S. economy and potentially the stock market. So you should be a happy camper if you're not an international, you're not over-diversified, but properly diversified. You don't own too much money in bonds. You don't own a bunch of money in non-traded REITs. Areas you shouldn't be, but be in the areas that you should. And that's what a money management firm like a Rezny Wealth Management does for their clients every day. Rob from Orlando. I have $800,000 in my 401k plan from a previous employer. I don't want to manage my own money. Should I roll that into an investment plan where I retire and I keep it separate with my overall investments? Yes. So let me explain, I think, what you're saying. If you retire from work, you have a 401k plan, which is a qualified plan. You want to have that transferred into what's called a self-directed IRA. So if you're working with a firm like Rezny Wealth Management, we help you with that paperwork. That money would then get transferred into a self-directed IRA. You would not have any taxation because it's a direct transfer. Then that money can be properly managed once it's discussed with the client, risk profile, goals and objectives, tax scenarios and things of that nature. Then it can, when it's in that account, it can then be massaged, modified, and really built for that client's needs and wants. But great question. Emily from Jacksonville. My husband and I travel extensively in retirement. How can I ensure our investment plan accounts last through our long-term retirement? That is an excellent question. So how do you know that your money is going to basically live or last as long as you live or last? Let's put it that way. You need to do a retirement projection. One of the things that I think is a stumbling block for many investors, Emily, probably like you, and I see this across the board, investors start investing money. Retirees start investing their money. They don't do the proper planning, and often the advisors they're using, because they're really selling investments and not managing money, they don't do the holistic planning that needs to be done as part of the money management. So what we recommend and what we do for clients at our firm is we do that planning process in addition to the management. So all of our clients have a retirement plan. We can actually show you, based upon spending, rates of return, inflation, taxation, how your money is going to last and grow over time. If your money is properly managed, in our opinion, even with withdrawals, if they're not extensive and you're overspending, your account should continuously grow through retirement, meaning every 5 years it should be worth more money, even after withdrawals, if it's being properly managed, in our opinion. And then what happens is you have a greater opportunity to take more income over time to combat inflation. That's how your money should be managed. Michael from Naples. I'm worried about the advice I'm receiving. Portfolio mostly stocks and mutual funds, have not done well for 6 years. My advisor doesn't answer my questions about timely portfolio changes. How often should an investment change be made? So we're a money management firm. Chances are you're working with an advisor who really is doing stock asset allocation. So to be brutally blunt, you probably have a set it and forget it portfolio. As a money manager, we make changes to our client portfolios when necessary and needed. So we don't just make changes to make changes. If we've bought the correct portfolio and things are going well, that portfolio is going to stay the way it is. But sometime throughout the year, we might have a stock that we take some profits on, or we sell that stock for ultimately greener pastures for the money. So you're always trying to upgrade your portfolio. You might own a certain bond position that needs to be sold to take a profit or a capital gain because there's greener pastures for that. You may have an ETF in the portfolio that needs to be trimmed and something else added because based upon the risk and the opportunity that other opportunities would unfold in the portfolio. So again, changes should be made when necessary to better the client's return and or reduce the risk of the portfolio. Hopefully that makes a lot of sense. I'm going to take a little break. As always, go to ReznyWealth.com, download any of our groundbreaking reports, and make sure you click on that consultation tab. We do manage larger portfolios. If you're qualified for our services, if you're tired of settling, if you're tired of being stressed out with your portfolio, if you want to put your interests first, contact our firm for a consultation. Go to ReznyWealth.com. I'll be right back. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. I want to talk a little bit about capitalizing on opportunities this year and the next 3 to 5 years in the investment markets. So what strategies can investors employ to take advantage of the current conditions? So think about this. If you look at the overall stock market, and most people when they invest their money, they either buy bonds or stocks or a combination of the two. Neither one is the best. There's times that bonds make some sense in a portfolio. There's times no bonds make sense in a portfolio. There's times a higher allocation to equities or stocks makes sense, and sometimes a lesser allocation. But let's talk about current conditions. What makes the stock market or stocks within the stock market go up? It's earnings. This year, the S&P 500 is projected to grow earnings around 14%. That's pretty good. There's other parts of the actual S&P 500 sectors that are going to grow earnings more than that. The way that stocks go up is earnings. If earnings are on the rise and they're above average, often it elevates stock prices higher. If earnings are flat or decreasing, stock prices are usually flat or decreasing. So all stocks don't go up when the stock market goes up. Often it's a small basket of stocks that do better than the overall market, and the reason is those stocks have higher earnings than other stocks. So when we have a portfolio, we look at the overall U.S. economy, the world economy, and then pick the best areas to be invested and then make those subtle changes as time goes on. The U.S. is going to grow, in our opinion. We're in a pro-growth economy. You want to be in pro-growth stocks or equities for the majority of your portfolio. ETFs, individual stocks are the two best tools in the toolbox. Bonds are also utilized based upon risk of the client and portfolio. And remember, not all bonds, just like not all stocks, are the same. So there are times when you own bonds that your strategy needs to be adjusted or changed. I remember a client that hired us a couple years ago, and he said to me, Brian, I've listened to your show for many, many years. I've been with 5 different big brokerage firms, all the big names you've heard of. And he said every single one of them always did what you talk about, asset allocation. They always had bonds in my portfolio. And when I asked them, why do we always own bonds when bonds are going down because interest rates are going up, they came back with the same answer. We always own bonds in the portfolio. He realized that wasn't a proper approach, but he went to firm to find a different approach, and they all did the same thing. He finally listened to my show for many years, decided to call our office and discuss our bond strategy and approach. And our strategy with bonds is simple. There's times you don't want to own any bonds. There's times you want to own some bonds or different types of bonds based upon current market conditions. Don't always own bonds in the portfolio. Sometimes cash or other all safe alternatives may be necessary to protect your money from bonds going down because interest rates are going up. Portfolio position is another big one. How should investors adjust their portfolio in anticipation of potential interest rate changes? This is the big one with bonds. So if you take a look at inflation a few years back that was rampantly high at over 9% under the previous administration, you should have seen that inflation was high. It was telegraphed a lot. The Fed telegraphed that they're going to be raising rates. You should have been reducing your bond exposure, raising cash, and or at least reducing the maturity level of the bonds in your portfolio. So your advisor should have done that. And I will tell you, if you're working with your typical fee-based advisor, they did not do that. So the last couple of years, your portfolio had pretty horrific returns. I will tell you within our client portfolio, and I talked about this for months on my TV and radio shows, we reduced bond exposure and really brought down the overall maturity level to floating rate types debt or floating rate bonds in the portfolio to protect the principal. Still get a good interest rate, but protect the principal from decline. Did that happen in your portfolio? Probably not, unless you're really dealing with a money management firm that is active and timely for your portfolio. Sam in Fort Myers. I plan to retire next month. I attended a dinner seminar on guaranteed income. It seems they are pushing annuities, but they say they are a fiduciary office. How can I ensure the firm I utilize is really a fee-only firm? The only way to ensure it is get it in writing on their letterhead. If they will not put on their letterhead that they are a fee-only fiduciary money management firm, they are not. 98% of firms are not fee-only. If they use the term fiduciary office, that's basically a mask or a sales pitch. So you think they're fiduciary, but they're actually not fee-only. That means sometimes they work against your money and they're selling you product for commission. Other times they're selling somebody else's investment management, third party, and that's what 98% of these firms do to their clients. It's sad, but it's true. It's you, the investor, that has to do the research to make sure that the investment management you're getting is truly in your best interest. Go to ReznyWealth.com, special reports tab, real advisor, fake advisor. It's a report about fee-only, fee-based, and commission, and how retirees and pre-retires get taken advantage of by these firms. You'll learn how to protect your money from bad advice. Andy in Naples. I have a pension from a previous job. Should I take that as a lump sum and invest it, or take it as a monthly payment? Andy, that's an exceptional question. So what I would say to you is this. You have to run the numbers. It's not an easy answer where take the lump sum or take the pension. There's times based upon how they calculate the pension, it may make sense to take the pension because there may be an inflation adjustment to it and based upon interest rates. There's other times when you do the calculation, it may make more sense to take a lump sum. There's other issues too when you take a pension. Do you take a single life? Do you take a joint life? And what's the cost difference of that? That all needs to be analyzed because sometimes you're better off taking the single life, buying cheap term insurance that basically fund the second life if in the event you pass away so your spouse gets a benefit after your death. So there's a lot of complicated things going on with a lump sum or pension. It needs to be calculated. You need to find yourself a qualified firm that can handle those calculations, and that would be a firm like Rezny Wealth Management on a holistic approach when we look at retirement, planning, and money management. Dean in Wilson. Cape Coral, my spouse and I have different risk tolerances. How can we balance our investment plan allocation to suit us both? Dean, what I often find is every couple, there's one more conservative and one more aggressive. So you're pretty much no different than most of the people we talk to. So how do you bring that together? I think the best thing is if both of you sit down with a qualified money management firm and you have an interview process, that person, and this is what we do in our office, talk with both of you. What you often find out is one spouse may not completely understand risk or vice versa. And if you actually educate them, they often start coming and aligning a little bit more alike. It's just that some people think risk is losing all your money, which of course don't invest in products like that. And other people are like, well, I can handle volatility. How much is that? So it's really a talking point with that money management firm to determine what is going to be best for your overall portfolio. I'm going to take a quick break. Go to ReznyWealth.com. Click on that special reports tab, download any of our groundbreaking reports, and always, if you're concerned about the way your money is being managed, if you're tired of settling for mediocre and you want a real money management firm that is actually managing your portfolio and taking the stress out of your retirement, go to Rezny Wealth, click on that consultation tab. You'll be glad you did. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. You know, I talked about technology a little bit. Let's talk a little bit about more technology in the sector itself. Remember, the S&P is comprised of many different sectors, whether it's materials, whether it's energy, whether it's technology, financial, so on. Technology as an overall sector is going to be a big driver not only of our economy, but the world economy. You as an investor need to look at your overall portfolio makeup. If you're still very lacking in technology sector as a higher weighting position, I firmly feel that's a mistake. So whether you're 40, whether you're 80, you need technology exposure in your portfolio if you are trying to grow your portfolio for future growth of income. Technology is vitally important. There's many areas of technology that are going to come to play. Of course, there's going to be storage, AI, software, computer chips, things of that nature. Not all technology is the same, but technology as an overall sector group is going to be, again, vitally important for long-term growth of a portfolio. The other area that I'm going to bring back again is international diversification. Look at your statements. Who are you currently utilizing to manage your money? Do they have international diversification in your portfolio? You should not. Don't own international. But you should, after this show, look at each one of your investment statements. What is your allocation to international? I will say it's a mistake. It's been a mistake for last year, 5 years, 10 years, 20 years. International's not going to do well in our opinion. And why is that? Take a look at Europe alone, made up of many different countries. Europe is in and out of recession, it seems, every 1 or 2 years. They have no growth, they have negative growth, they have a little bit of growth, but it's in and out of recession. Why is their stock market done poorly over decades? Because they don't have growth. Bad policies contribute to bad companies with slow growth or no growth, which is an area you want to avoid. Again, I urge you, look at your statements and don't settle for your advisor saying, well, we need to have international exposure. You don't. You can be properly diversified within the U.S. Retiree strategies. How often should a retiree optimize their portfolio for both growth and income in the current market? You should be looking at your portfolio daily. It doesn't mean you're making portfolio changes daily, but every investment in your portfolio needs to be reviewed on a daily basis and researched by the firm that is managing your money. That's what we do. If you're managing your own money, I hope you're spending 5 or 8 or 10 hours a day researching the investments in your portfolio and also looking for new upcoming investments to upgrade your portfolio. It is vitally important that pre-retirees and retirees have a stance of what we consider total return of a portfolio. You need growth, you need income. The combination of the two is considered total return. Total return is going to give you the chance to grow the portfolio so you then have higher income streams as years go on to combat inflation. Wouldn't it be nice when you're 65 and you're taking $10,000 out of your portfolio, by the time you're 65, you now could take $12,000, then $14,000, then $16,000, because your portfolio is physically growing because your total return strategy is working. If your portfolio isn't worth more every 5 years, even with withdrawals, your money's probably not being managed properly, and you should be concerned. Chris from Cape Coral. I'm retiring at age 70 next year. I have about $1.7 million in various accounts, some with a Wall Street firm, some self-managed. None of have performed as expected. Are you taking new clients? We are taking new clients, and we do work with larger clients, and you would clearly qualify. You're in that range. What I would suggest is call the office during the week, or you're more than welcome to visit ReznyWealth.com. Click on that consultation tab. And as I always discuss in my TV radio shows, we always like working with nice people to do business with. Adam in Port St. Lucie. I own shares of Apple, about 40% of my portfolio. What are your thoughts on Apple stock? We actually like Apple. We do own that in managed accounts, fair disclosure, but we do not own 40%. What I would suggest you do is you need to trim that position immediately. 40% of any one stock is ridiculous. A maximum exposure to any one stock should be around 5% for an aggressive growth investor. Any more than that, you are taking on too much risk. You need to be properly diversified, not overly diversified, and certainly a 40% exposure to Apple, that's not a good place to be. Matt from Naples, I have an inherited IRA. I need to take a required minimum distribution. Can I consolidate with my other investment plans? Matt, when you have an inherited IRA, that needs to be kept completely separate account than your other accounts. You do not want to commingle that account overall, so keep it separate. Sam in Lakeland, my adult children are still relying on me financially. How can I invest to help them while preserving my retirement account? Sam, I would suggest your adult children need to become adults. The worst thing you do for your children is keep supporting them as adults. What you're doing is you're giving them bad habits in adulthood, which is only going to lead to their financial demise one day that you're not there. Unfortunately, too many investors do that, and you're only hurting your kids. Folks, I am just about out of time. As always, visit ReznyWealth.com. It's time to lift the weight of financial stress from your shoulders. Don't settle for mediocre investment advice or have your investment dreams ruined. Smart investors like you are calling my firm every day for real money management and real advice. We can help you too. Don't settle for mediocre. You don't have to. Honesty, integrity, compassion, and competence. That's the Rezny Wealth difference. Call us for a consultation today. Schedule, take the stress off your shoulders. Remember, you have one retirement. It's best for you to make sure your portfolio is properly positioned and the advice you're getting is truly benefiting your financial security. Call our office number or visit ReznyWealth.com and make sure you download any of our groundbreaking reports. Continue that retirement education. Protect yourself, protect your loved ones, and your family legacy. Have a safe and profitable day.
Are you tired of the same old song and dance from financial advisors, the empty promises, the hidden agendas, and the constant push to sell products? Well, it's time for a change. At Rezny Wealth Management, we're not your typical financial advisors. We're fee-only fiduciaries, which means our loyalty is to you and your financial well-being, not to the products we sell. Because we don't sell products. We provide honest, straightforward advice based on your unique needs and goals. No gimmicks, no flavor of the month, just genuine guidance rooted in integrity, compassion, and competence. We're not here to make a quick buck. We're here to be your trusted partner, helping you navigate the complexities of wealth management with a steady hand and a clear conscience. So, if you're ready to experience true fiduciary care, if you're ready to take control of your financial future, join us at Rezny Wealth Management. Honesty, integrity, compassion, competence, Rezny Wealth Management, your partner in financial freedom. Call us today or visit our website to schedule a consultation.